Redwire, the space infrastructure conglomerate, is going public via a SPAC. The SPAC is Genesis Park, trades as GNPK. I never heard of them before. Am I just living on the wrong planet? Especially given the fact that they've accomplished so much, enabling every mission to Mars, going to Pluto and beyond, spacecraft technology that enables it to build and assemble itself, optical fiber manufactured in space, which is like 100x better than traditional optical fiber, and they're enabling this vision to, for humans to land and build a permanent presence on the moon. And here it is, they're talking about infrastructure that enables nearly every space mission. They talk about a heritage working in the space industry for over 50 years, yet I've never heard of them. What's going on? And the reality is, the reason why I haven't heard of them is because it's really a summary of about 7 different businesses that were acquired by AE Industrial Partners, which is a multi-billion-dollar private equity firm. And the way they looked at it is they said, hey, we want to build a space platform. We hear that space is getting interesting. We think that there's some real tailwinds here. Let's acquire a bunch of companies and then make it one giant player, and maybe there'll be some cost synergies as all these different subsidiaries will have to use, let's say, the same engineers for testing, or it'll be cheaper because we can lower our G&A costs, or maybe we can win bigger contracts because now we have more size. So those are sort of the arguments that a private equity player would have. I do have a little bit of my own 10 cents that I can bring here, just given that private equity was one of my first jobs that I had when I was starting my career on Wall Street. Just a little bit of background. You're watching Unrivaled Investing. My name is Daniel. Usually I'm looking for potential multi-baggers, types of companies I think can go up hundreds or thousands of percent, and that's the reason why I wanted to make this video on Genesis Park, which is going to be merging with Redwire. I'm calling out the fact that several Unrivaled Investing Journey subscribers are the ones that called this out to me, saying, hey, Daniel, we think this is a compelling company. It seems like it's a reasonable risk reward. And so because of you calling it out to me, I'm making this video. And in all honesty, it does strike me as an interesting risk reward. And so let's dive a little deeper. And so as we look at this, understanding that this is a private equity space baby that, was made by AE Industrial Partners, acquiring a bunch of different firms, they are banking on some major tailwinds that I think people are recognizing are going to exist. And not surprising to see, companies like ARK launch space-themed, investment firms where they see these trends, where they see that launch costs are down 95% in the past decade. This is a game changer when you have launch costs drop that much. And that's the reason why they think the number of satellites that are going to be in orbit are going to go from 6,000 as of April 2020 to 50,000 plus by 2030. So over the next decade, you're going to see about a 10x increase. So that is if you can ride that wave, that can be a huge win. Lots and lots of satellites getting put up. And so where does Redwire potentially fit in with all of this? And the reality is they offer a lot of different solutions, like space-capable robotics, microgravity additive manufacturing facilities, deployable boom, solar arrays and antennas. They're talking about camera systems, human-related camera systems, guidance navigation systems, solar arrays, and they show specific examples, like with the Orion spacecraft or the International Space Station, and the Argonaut, which we'll talk about in a second. So there's a lot of different solutions that they're actually tapping into, and they're looking at addressing several major tailwinds. So it's not just launching more and more satellites, but hey, as the costs go down, there's a lot of things that are enabled with space, such as on-orbit servicing, assembly, and manufacturing, i.e. building stuff in space. And what are the new things that you can build? And hey, we're probably going to want a commercial and a habitation facilities in space, and potentially on the moon. And then hey, maybe in the future we're going to want rapid production of low-cost spacecraft. And what can they do to bring that possible? And space monitoring of assets such as satellites. Hey, how do we make sure that things aren't exploding or that other countries aren't shooting down our assets? This is something for national defense. What are the cameras that we need to make sure that everything's up and running and that we can see what's going on from space? And then also all these components, sensors, and systems that go with it. So I see several potential tailwinds, several potential lotteries or option, several different areas where they could win big potentially. Several different tailwinds if either of these catch. And so then you look at, well, have they actually won anything? Have they actually gotten any major contracts? And here it is with NASA. NASA has selected Redwire as the prime contractor on the Archinaut 1, which is the first on-orbit demonstration using additive manufacturing to build and assemble complex components in space, which is really interesting. They're talking about effectively this satellite, which will have an array that'll be so much more efficient, that could result in 5x power output when compared to state-of-the-art solar arrays. And it was a $74 million contract expected to launch in 2023. So this is at least from their company presentation, and I'm wondering, is this legit? As we're thinking about this, talking about this small spacecraft will 3D print two beams that extend nearly 33 feet from each side of the spacecraft. So this is what it'll look like, this cost-efficient satellite built in space versus the traditional, which is much smaller. And the reason why this could be much more efficient is because normally you have to be able to fold this thing up so that way it can easily go in the space rocket into space. But here, if you can actually print stuff in space, then you can make things that wouldn't naturally fit in the rocket that might be, multiples better than the current design. So is this legit, this whole winning a thing by NASA? And here it is. I go straight to the NASA website, and they talk about, as NASA's Artemis program prepares to return explorers to the moon by 2024 and establish sustainable missions, i.e. set up a permanent base there by 2028, a prelude to crewed Mars missions to come, NASA seeks to develop an expansive, robust space infrastructure and conduct remote in-space manufacturing and construction. To achieve these goals, NASA and its partners are developing robotic technologies to rapidly, efficiently, autonomously manufacture and assemble hardware components and tools in space. So this is all about 3D printing in space. They say the lead developer is Made in Space, and I'm like, uh-oh, who's Made in Space? That's not Redwire. Then I look it up. Made in Space is a Redwire company. This is from the NASA website, so I'm double checking this, and this strikes me as a legit company, 74 million contract size, and so I'm getting interested here, winning major contracts, and that's not that's only one of several major contracts that they've won. They're also working with Firefly Aerospace, which won a $94 million contract from NASA. This contract is to deliver a suite of 10 NASA-sponsored science and technology demonstration payloads to Mare Crisium and the Moon's Crisium Basin. So this is effectively, helping set up a presence on the moon. Okay, but Firefly isn't Redwire, and they talk later on, Firefly's expertise in rapidly developing and operating efficient space systems combined with expertise from Redwire in development and operations of deep space systems, advanced solutions in GNPK and spacecraft software. So I'm looking at this, I'm like, okay, so there's another data point of a real contract, tens of millions of dollar contract that they're going to be getting part of, that's going to be enabling this major space infrastructure build in the coming decade. And then another contract that they just announced today, or another deal where they talked about Redwire successfully delivering the first pair of the IROSA solar arrays to augment the International Space Station power supply. So as if it wasn't just, pretty pictures, it strikes me as legit stuff, where they're saying the solar arrays are currently undergoing flight package integration and are slated to launch on SpaceX's 22nd commercial resupply mission to the International Space Station. Combined, the 6 new arrays will produce more than 120 kilowatts, substantially improving the overall power generating capability of the ISS by 20 to 30%. Redwire is proud to partner with Boeing. So Boeing is one of the largest, prime contractors of, let's say, NASA and the U.S. government. But for specific cases, these contractors will work with Redwire, and Redwire will either be the contractor to them or they will become the prime. So Redwire is providing this critical infrastructure to support human spaceflight in low Earth orbit. This is just incredible stuff. Seeing, whether or not it's enabling moon landings or enabling building this stuff in space, to building out these solar arrays for the International Space Station. This strikes me as a very real company with real wins, real contracts that are worth tens of millions of dollars or should help drive their revenue in the future. How does this translate into money? Because it's not only cool stuff, you also have to translate into actionable items and real risk reward in terms of your investments. And so looking at this is what they're penciling out for their revenues and their profits. They're saying about 120 million in revenue in 2020, and they're expecting this to go up multiple times in the ensuing 5 years to 1.4 billion by 2025, which is really interesting, seeing this sort of trajectory where their growth rate sort of 45%, then 37%, then 45%, but then it really amps up in the coming years. Maybe that coincides with these major projects that we were just talking about, where it's penciling out, several years out. But interestingly enough, they are profitable. They're $16 million in free cash flow, which sort of fits the playbook of a private equity firm, like I would expect. Look, if you're going to buy a bunch of companies, these private equity firms, they want them to be self-financing. Usually you're going to put some debt on it. We're going to talk about that in a second. But here it is. They have they're projecting $16 million in free cash flow that they could otherwise use to augment their growth, reinvesting in the business. So, it makes you wonder, do they even need the money from this SPAC deal? And you look at the SPAC deal, you got about $270 million in cash coming in, $170 from the SPAC, another $100 million from the PIPE. So $75 million's paying off existing shareholders, then about $170 is going to the balance sheet. But one should recognize this $170 million going to the balance sheet. The reality is, I think a chunk of it's going to be paying down debt, and this is just part of the private equity playbook. Because how do I know that this is paying down, or why do I think this is paying down debt? It's because it's $170 million here, but they're saying pro forma for the valuation, their net cash position is $60 million. So if you have $170 million going to the balance sheet and only $60 million shows up as net cash, oh, okay, you're probably paying down your debt. And so, okay, so why is this part of the private equity playbook? And so one should understand the way private equity works is sort of like heads I win, tails I don't lose, or I lose less. In that private equity will use the companies will borrow money. So it's not the private equity firm, it's the companies that will borrow funds. And then so you'll start with a platform company, and then this platform company will borrow funds to acquire other companies. And the private equity firm, they will own that stake in the platform company. But they're, in terms of the risk, that debt isn't recourse to the private equity investors. It's recourse to the platform, which, is Redwire, and they're looking to acquire and build this up into a space infrastructure company. And so this is sort of saying, hey, we made a bet in the last few years acquiring all these different space assets. Now we're going to do this SPAC, clean up our balance sheet, make it really refreshed, and now we're going to have a nice net cash balance. Because currently it's a debt balance. Now we're going to have a nice net cash balance, and we can play that game again, acquire a bunch of smaller players, enhance our growth. And so that's part of the story. So one needs to understand. I mean, this is part of the insights that you have when you've sort of seen how the sausage is made working from private equity. Is like, you need to understand what's going on. This is part of the game. I'll talk more in an exclusive video my thoughts on private equity, but let's keep going in terms of you're effectively getting a restart in terms of the balance sheet to do more and potentially keep playing that game of finding companies to acquire. And so the next question is, will they then deliver, recognizing that they don't actually really need the cash given that they're free cash flow positive. And keep in mind, they wouldn't have a lot of debt on their balance sheet prior to this acquisition if they weren't free cash flow positive, because they wouldn't be able to finance it. That's part of the private equity playbook. And so, looking at this, will they actually be able to deliver on this growth in the years to come? I mean, look, talking about growing by 10x in the ensuing years, that is no small feat. And a lot of, we are currently in a stock market where story stocks like this, companies that aren't showing the execution quite yet, but it's more of a promise or an idea, are getting discounted versus the ones that are actually delivering. And so the question is, will they be one of those stocks that deliver? And so, they point to the fact that, look, our backlog, 85% of 2021 revenue is either backlog or where Redwire is the incumbent provider for this. So that, that covers the vast majority of their guide for 2021. So they're saying, look, we do think we can get pretty close to this 163 million figure just based on backlog and existing programs. But that does sort of leave the question of, well, wait a second, it's one thing to go from 120 to 160. What about going from, 400 to 800 in a few years from now? What's the probability of actually delivering on that? So I think the odds of 2021 are looking a little, looking pretty solid. I've definitely covered some SPACs, Journey subscribers will know about it, where, the company's penciling out like 200% growth, but it's fully covered by their backlog. This is not as strong as I'd like, but still pretty darn good. The question is also their future growth in the years ahead, like looking 2-3 years out. That's a lot tougher to sort of underwrite given what I'd argue is the backlog currently. And then, looking at these financials, a few other additional thoughts, one of which is they do break out national security, civil, commercial, and other in the years ahead, saying, look, these are each going to be huge pieces of the pie, where commercial and other is going to be, like 20x growth, national security will be like 10x growth in the ensuing, 4 years. And so, that's impressive and all, but one should recognize, look, this is once again a space private equity, a private equity space baby that, you add all these different pieces together. And so they likely don't even know their own breakdown for 2019 just because or 2020, just because it was assembled then. So, notice how this is blank right here. So I would take their forecast with a grain of salt, recognizing, look, they weren't able to put the figures here for how it breaks down. And look, no one knows the future exactly unless you have like 99% revenue retention and that type of, business. And this is not that type of business. This is a contractor type of business. And then another aspect that sort of makes me scratch my head is that their R&D is just so small relative to their revenue. I mean, here it is. It's effectively $3 million in R&D spend relative to revenue, so 3% on R&D. I'm thinking companies like SpaceX, Elon Musk has never been shy on spending money, especially on things like innovation. And so I'm just wondering, like, is this going to be enough for them to be competitive in the future? I'm not saying they compete with SpaceX, but what I'm saying is, like, does this model, like, yeah, they've invented and clearly done a lot of firsts in the space industry, and they do have this heritage, but, buying a bunch of assets and throwing them together, that's one thing versus finding a company that's constantly innovating and spending and has a budget and culture and legacy that's used to doing that. And that's sort of a question mark for me to think, like, will this actually be intelligently spent? And, can you actually translate this R&D? Do you actually have the resources and the wherewithal to actually deliver? So it does make me wonder if the odds of winning big, like they're proposing here, is actually a little bit lower, just given the fact that it's so little spend on R&D. 3%, less than 3% here, less than 4% here on R&D. Also just quick take on the business model. You're talking about 20 to 30% gross margins, and they're expecting EBITDA margins of effectively mid-teens to high teens, maybe around 20%. So when you're thinking about the valuation, you're probably going to want to think about this type of value, this type of operating margin as well, which is probably 15 to 20%. And you can see what their free cash flow profile looks like here as well. But what about Redwire's valuation, and is now the time to buy? It's a SPAC that's effectively trading at its net asset value, not really pricing in a lot of upside potential. So is the valuation, is this a reasonable deal? Before diving into that, just a quick plug, if you will, where, if you enjoy learning about potential multi-baggers, types of companies that could potentially go up hundreds or thousands of percent, make sure you hit that subscribe button. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking and buying, investing in stocks that I think have multi-bagger potential, go to unrivaledinvesting.com, click on Journey. There's a whole lot of exclusive content. You can see all of the exclusive content in the catalog of content in the description of this video. There's a link to that there. And, for example, one of which I'm going to do an exclusive video following up with additional thoughts on Redwire after this, so you can click on that if interested. And also each month I'm layering in new potential multi-bagger ideas for new investors, thinking about, hey, how do I build out my portfolio? Each month there's new ideas for you to consider at unrivaledinvesting.com. Let's go back into understanding Redwire's valuation. And looking at Redwire's valuation, so first of all, you're around a $700 million market cap. Not sure what the 2019 revenue is. They're saying their 2020 revenue was around 119 million. They're saying that was about 45% growth. So I could back in, but I didn't see it. So I'm just putting the question mark just to call out that you don't have the historical financials, which is a key point, to consider here, partly because this is amalgamation of various different companies that this private equity firm acquired. So then next up, this growth, they were penciling out effectively high 30% growth for 2021. So I put a range of 30 to 40% growth. And then what's the long-term profit margins? Management's effectively saying, hey, we think we could be 15 to 20%. So I'm putting in 14 to 18% as a range from low to high. Slap on a 25% 25% tax rate. And so that shows sort of like a pro forma, optimized profits for 2021. What they could be at is effectively saying they're at like 30 to 40 times for a company that's growing at 30 to 40%. And that starts smelling interesting. I like seeing setups like that. So then the next question is, well, what's the growth rate you want to assume for the ensuing years? Because, I try to take a logical 5-year framework. And so over the ensuing 4 years after 2021, assuming a revenue annualized growth rate of somewhere between 20 and 45%, based on a low or a high scenario, and an N multiple of, let's say, 15 to 30 times over, in 5 years from now. So what it's valued at in 5 years from now, then you effectively get downside of about 20%, upside of over 300% upside. So that does strike me as actually a really interesting risk reward. Relative to a lot of companies I cover, this is actually a lot more compelling. And part of this just reflects that a lot of the sizzle has gotten taken out of the market and you're left with more stake-oriented valuation. So this does get me a little bit more interested. I haven't yet pulled the trigger on it. I'll talk more about that in an exclusive video. But I could see why several Unraveled Investing Journey subscribers wanted me to look at this, given this sort of risk-reward dynamic. Now, keep in mind, this is just a hypothetical framework in terms of how I'm thinking about the risk-reward. Of course, the stock price could go way higher or way lower, but this is a framework for one to consider and think about. I have called out some stocks in the past where I actually have pulled the trigger and I do own, such as Alibaba. Alibaba, which is a stock that, based on its various different pieces, I actually do think it is quite reasonably priced, and there's a reason why I personally do own it. So you can watch that video. And, here's a list of all the potential multi-baggers, and you can click on the links. It's in the description of this video on my April potential multi-bagger. I'm calling up as saying it has 4x potential. So if you enjoyed this video, effectively learning about Redwire, if this is not just a new story, it's not a new story stock, it's a company that was built up over the last few years, strikes me as super interesting. 50-year heritage in space, that's quite incredible, and the things that they're looking to tackle are really, this is the future. So I'm pumped about it. This is actually I've actually done a few space stocks so far. I'm getting a little flabbergasted over here because I've done some space stocks before where I was just like, nah, I don't see it. Where here I'm like, pretty interesting. And so, yeah, if you enjoyed this video, make sure you subscribe. If you're already a subscriber, hit that thumbs up. Thanks so much for watching.